Welcome to our webinar today on the consequences of the new tax law on charities and estates with the subtitle, What Nonprofits and Their Supporters Need to Know. This is Jim Bell, President and Founder of Bell Investment Advisors. Thank you for joining us today. I will take questions live as I go through the presentation today, so please submit those in your question box. If I'm not able to answer those live, I will definitely get back to you after the webinar is over. So we always appreciate having questions. So let's go ahead and get started. This is our staff here at Bell Investment Advisors. We specialize in providing cash flow for your retirement, for your family's education, and for living a good life to the very end. In today's presentation, I'm going to cover these 7 areas. Start with qualified charitable distributions, or QCDs, standard deduction or itemized deductions. These are things that have been affected by the new tax law signed in December. Third, partial elimination of tax savings for charitable contributions. The importance of vision and mission for nonprofits. And there are some solutions for donors as a workaround for some of the consequences of the new tax law. Estate and gift tax consequences, I'll go over those, and then we'll summarize with some conclusions. So I want to start today with qualified charitable distributions. This is a tool that pre-existed the new tax law, but because of the new law, these QCDs, qualified charitable distributions, have become even more important and effective for donors and for nonprofits. So it's important as background that we all understand the elements that go into the QCD rules. So on this slide, we're talking about required minimum distributions. With age comes wisdom, and also a required minimum distribution from your individual retirement account. This starts at when you reach age 70 and a half. The government wants you to take out distributions so they can tax those distributions before you leave the earth. And so the 70 and a half is the age where required distributions start. So all distributions from IRAs are taxable in the year they are received. So the tax consequence of these distributions certainly can't be ignored, and you can't defer the distribution, but you can reduce the tax impact. And the best way to do it, from my point of view, is the use of qualified charitable distributions. So the way this works, and as I mentioned, this pre-existed the new tax law. It was something that Congress approved 1 year at a time. Leading up to this, it was finally made permanent, and so that's why it's such an important aspect of what we're talking about today. So what the qualified charitable distribution does is it makes a contribution directly to a 501c3 or a nonprofit organization. And what's important about it from the point of view of the donor is that the distribution amount can be excluded from your taxable income. So the point I'd like to make here is anytime you have to report something as taxable income, it gets complicated because that shows up in the income category of your tax return, and then you have to, the deductions follow. But it's much cleaner and more effective, and you get a better result in using these qualified charitable distributions that go directly to the charity. It lowers your adjusted gross income, which is a good thing. It avoids possibly a potential higher tax bracket, and and the consequences of the phase out of itemized deductions. I've been part of the Oakland Symphony community for many years and just served 6 years on the board. So I'm using the Oakland Symphony as an example of a recipient for qualified charitable distributions. The maximum amount of qualified charitable distribution is $100,000 per year. So if you're married and you're filing jointly as a couple, you can each give $200,000 per year to several charities. These QCDs don't have to be all to one charity. They can be divided up among, it's unlimited the amount of charities you could choose. But a married couple, the point here is that the married couple could use the QCD to contribute $200,000 a year to charity, and it avoids showing up as income on your tax return, which produces good outcomes. So here's some logistics in terms of what you must do. You must be subject to the required minimum distribution. So you have to be 70.5 or older. This doesn't apply to people who are in their 60s. It has to be 70.5. Number 2, work with your IRA custodian to have a check made payable directly to the qualified charity. And number 3, make sure the distribution does not have tax withholding. Tax withholding would defeat some of the purpose here. And we recommend for better record keeping that instead of having your custodian send this check directly to the charity, that you have the check mailed to you and you make a copy of that check for your file so you have very complete records, and then you can send it or deliver it to the charity or charities of your choice. So just some things not to do. Don't have the check made payable to you. If you do that, it's going to show up as taxable income to start with on your tax return. Do not have taxes withheld. 401ks, defined benefit plans, and other qualified retirement plans are not eligible for this feature. Also, simplified employee pension plans or SEPs and simple IRAs, if they are still active and receiving contributions, they're also not eligible. If they're no longer active and not receiving contributions, this qualified charitable distribution tool will apply. But before requesting a qualified charitable distribution, always confirm your eligibility and intent with your tax professional. And remember, you're not getting older, you're getting better. And from me, long live the Oakland Symphony. So that's important background of the importance of QCDs, and I'm going to illustrate why it has such an impact as we go through this, but we'll come back to the QCD. So my point here on this slide is that one of the kind of major concerns is that this new tax law in regard to individuals, not to corporations, those changes are made permanent, but to individual taxpayers, all of these rules expire in 2025. So the Republican Party has received quite a bit of criticism for that, and they may be trying to fix that because many people are not happy about that, and it certainly interrupts long-term planning. Second point here is quite obvious. Income tax deductions reduce your taxable income. And one of the big changes is that in the area of whether to take a standard deduction or an itemized deduction on Schedule A is very much in play at this point. So I'll go through that in some detail, but you can't do both a standard deduction and itemized deductions. Taxpayers must choose one or the other. And the criterion for making that choice is will the standard deduction or itemized deductions provide the most tax savings. That's how one decides which way to go. So big feature of this new law that was signed in December of 2017 is that it nearly doubles the standard deduction starting this year in 2018. So that standard deduction has gone up to $24,000 for couples filing jointly and $12,000 for individuals. So the consequence of this is that millions of taxpayers will no longer itemize deductions, including charitable contributions. Why is this so? Because the increased standard deduction will save them more in taxes. So the thing about the standard deduction at $24,000 for couples and $12,000 for individuals is that it's a given. You get that regardless of whether you make charitable contributions or not. And for many American taxpayers, a $12,000 standard deduction or $24,000 for couples will be greater than what their charitable contributions would be. So this is something that I want to go into in some detail. So this could be a major disruption for U.S. nonprofits as the result of many donors no longer receiving tax savings for their contributions. So as I indicated earlier, the American taxpayers, they're eligible for the $12,000 standard deduction or $24,000 as a couple, whether or not they make charitable contributions. So the issue here is how much will that mean to donors that they won't see a specific line item benefit on their tax return for making those charitable contributions. And the Urban Brookings Tax Policy Law Center estimates that the number of tax returns claiming charitable deductions will drop by 50% for 2018. The reason being, as I said earlier, is that they're already getting a greater deduction from the standard deduction than they would be by itemizing the deductions. So I want to give an example here. This is Fred and Ginger, and they usually donate $10,000 per year to charities. They don't have a mortgage, but they do itemize $10,000 in state and local taxes. For 2017, their joint standard deduction was $12,700. So that was under the previous law. So in this case, referring to 2017, their $20,000 in itemized deductions from their mortgage interest and from their charitable contributions was greater than the standard deduction of $12,700. So for 2017, they paid less tax by itemizing on Schedule A. Now in 2018, the standard deduction is the better choice because the standardized deduction of $24,000 is greater than the $20,000 they could take in itemized deductions. As a result, Fred and Ginger will receive no specific tax benefit for giving to charity in 2018 unless they increase their giving to the extent that their itemized deductions exceed $24,000. I hope that's clear to everybody. If it's not, send me a question and we can unpack it more. A consequence of this, and as I mentioned earlier, the issue as I see it is that how much will this mean to donors, and what can nonprofits do to respond to what I think of as a disruption? So my point here is that the obligation or opportunity for charities and nonprofits to really hone their communication skills about the vision and mission of their nonprofit is more important than ever. So it's always been important to me, whether it's talking to donors or clients for that matter, to find out, what do they really care about? And that's what you want to address. And people are different. They care about different things. So it's really important to understand that, to have that conversation. and the story, if it's appropriate, how your agency will fulfill what they care about. That's how you frame your story or your narrative. And as I mentioned earlier, the benefit of tax savings because of the increased standard deduction will no longer apply to millions of donors. And how important is that going to be? I want to give an example of a narrative that was very impactful to me in my life experience. This was years ago. I was at a gala for the Oakland Symphony, and one of the most admirable features about the Oakland Symphony as an organization is that it uses a major part of their budget to provide free music education in the Oakland and Alameda public schools. So they serve 20,000 students overall annually, at least, with some form of music education. But specifically, the children that want to play instruments get individual lessons, group lessons, or individual help from professional musicians in the Oakland Symphony. And at this particular gala years ago, a father of two girls who were interested in playing violin, they lived in East Oakland, he stood up at this gala and gave really what was kind of a witness or a testimony to how this feature, this mission of the Oakland Symphony had changed his life, his family's life, the quality of life in their neighborhood, that his daughters really benefited from this individual attention in learning violin. And they were famous in their neighborhood because they were taking advantage of this, and it kind of raised the bar in the whole neighborhood and their schools. Both girls went on to get a scholarship to Northwestern. The oldest daughter is now a professional violinist in a nationally known string quartet, and the younger daughter has kept up violin, but she decided she wanted a career in public health. So I was very inspired by this very specific example of what the music education mission of the Oakland Symphony did for one family, and there are many more stories like this. So back to we'll start with some solutions for donors. One workaround, so to speak, is that donors can bunch their donation every few years so that their donation deduction exceeds the $24,000 standard deduction, as this case with Fred and Ginger. So this couple could plan to donate $20,000 every other year, so that combined with their state and local taxes at $10,000, their itemized total of $30,000 would provide a specific tax benefit from the donation because it's greater than the standard deduction of $24,000. So in this case, Fred and Ginger would itemize their donations and other deductions when they bunch their donations. When they're taking the year off or years off, they'd take the standard deductions because in both cases they get the most tax savings. So let's go back to the importance of qualified charitable distributions. Just as a reminder, this applies to taxpayers with individual retirement accounts who are 70.5 years or older. As I mentioned earlier, the QCD excludes the donation from taxable income. It makes it much more efficient that way. Using the QCD may result in a lower tax bracket. It may lower the Medicare premium. It may avoid the 3.8% tax on net investment income, and it may minimize or avoid the alternative minimum tax, which has been adjusted but still exists. So another example of this to drive the point home, let's assume Fred and Ginger are both 70.5 years old. and every year each takes a required minimum distribution, and which together totals at least $10,000. By using their QCD to donate $10,000 to charity, they enjoy a tax deduction by lowering their taxable income. Because of the QCD benefits, they enjoy a tax savings in addition to the $24,000 standard deduction. So this is why QCDs are really relevant in light of this new tax law, that they can get around the situation where if they weren't 70 and a half, they would still be limited to the $24,000 standard deduction and wouldn't get credit for the charity deduction. But because they have IRAs and they're over 70 and a half, they can get the benefit of the $10,000 contribution, which lowers their taxable income, as well as the $24,000 standard deduction. So just a couple more things to point out about the new tax law. Want to change the story to John and Sally. This couple earns $1 million in joint income. They live in California. For the income tax effective, California rate is 9.5%. So their state income tax is $95,000. They own a home appraised at $2 million in Alameda County, where the property tax is 1%. So they have $20,000 annually in property tax. So this adds up to state and local taxes total, or SALT as it's known, of $115,000. Now that we're in 2018, how much can they deduct? Well, the answer is $10,000. That's the difference between 2017 and 2018. In 2017, they could have a deduction against their federal income tax of $115,000. The new tax law has set a limit on that at $10,000. So the result is that they have now $105,000 in non-deductible state and local taxes. Their effective tax rate is 43.6%, state and federal combined. So in this case, this couple is forfeiting $45,780 in tax savings. That's relevant to charitable contributions, because this is $46,000 that John and Sally no longer have that they could give to charity. Under the old SALT deductions, they were unlimited. John and Sally would have been able to deduct the $115,000. For 2018, the state and local tax deduction is limited to $10,000 per tax return. That's a big change. Because of the new tax law, there's 6 states where this change in state and local tax deductions hit hardest. These 6 states that do have high state and local taxes. So these are New York, New Jersey, Connecticut, California, Maryland, and Oregon. This is where this change has the greatest impact. And it's difficult to overlook that these 6 states are blue states, and the Republican red states are in the majority. So it sure looks like a punishment of blue-leaning states. Finally, I want to talk about the estate and gift tax under the new tax law. Just to be clear, the gift tax exemptions apply to gifts made during a lifetime, and the estate tax applies to assets left at death. So we're seeing some changes here as well. In regard to the gift tax, the new tax law, there is no change for 2018 in the annual individual gift tax exemption of $15,000 Just to give an example here, let's say that Fred and Ginger, they can each give $15,000 to their two daughters. So having two daughters, they as a couple, they can give $30,000 to each daughter. The daughters are also married, so they can give $30,000 each to their spouses. So I think this brings us up to a total of $120,000. Let's assume they also have 4 grandchildren. They can give $30,000 to each grandchild. So just want to make a point that all this falls underneath the exemption amount, so there's no need to file a gift tax return because they're within that $15,000 each or $30,000 as a couple to each recipient of the gifts. And these gifts don't have to be to relatives; they can be to friends, strangers, and so forth. And at this level in the example, they do not need to file an annual gift tax return. And these gifts remove assets from Fred and Ginger's estate, which is one reason to do it. Beginning in 2018, the new tax law nearly doubles the estate tax exemption to $11.2 million per individual and $22.4 million per married couple. And this exemption will be adjusted for inflation each year until it expires in 2025. So this estate tax exemption is a big change, but it will expire in 2025 unless Congress extends it or changes it. What's relevant about this is that the Urban Brookings Tax Policy Center estimate that in 2017 there were 5,300 estates that owed taxes. Now in 2018, with this increase in the estate tax exemption for 2018, out of approximately 2.7 million deaths anticipated in 2018, only 1,700 states will owe estate tax. So it's a big reduction in the situations where estate tax will be due. My third point here is that inheritance has a very sad history. It's a bit similar to lottery winners. The data on lottery winners shows that it's in many cases it's more negative than positive. It really tears apart families. Money does strange things to people, especially if it's not earned. So there's quite a movement in the United States to study how large inheritance affects children and grandchildren, and that, as William Buffett said, he has given enough to his children that they can do something, but not so much that they can do nothing. So there's a balance there that's important to point out here, instead of just kind of thinking by rote that everything will be left to the children. One of the final points here is about donor engagement again. In 2018, there will be approximately 3,600 estates that will not have the tax incentive they would have had in 2017 to donate to charity. So it raises the question again, is how much is this going to change behavior among wealthy people that might owe estate tax? Again, I think the ability and capacity and skill of nonprofits to engage their donors because of the value they produce becomes even more important, because that motivation of tax savings is different than it used to be. And as this new tax law progresses through time, we'll begin to understand better the impact of the new tax law on charitable giving. Wanted to make a point about mortgage interest. The new law allows homeowners with existing mortgages to continue to deduct interest on a total of $1 million in mortgage debt for a first and second home. So families, couples, individuals who had $1 million in mortgage debt before 2018, they're grandfathered into the same limits as existed in 2017. For new home buyers or more mortgage originators in 2018, that limit falls from $1 million to $750,000. So in other words, you can only deduct interest on $750,000 in 2018 going forward until this expires in 2025, whether it's for a first home or first and second home. Also applies to home equity lines of credit, where money you borrow against the equity in your home, it must be used to improve the property in order to qualify as a deduction. And again, the total mortgage deduction, including the home equity line of credit, must be $750,000 or less. So in conclusion, qualified charitable distributions, as I've tried to emphasize, are more important and effective than ever. The higher standard deduction will affect mid-range donors. Big donors, not so much. People who regularly give, $20,000, $30,000, $100,000, $250,000. The changes in the laws is not going to be that different for them. But for these mid-range donors, the tactic of bunching gifts every few years is a solution when it's important to them to see that they do get a direct tax benefit for their donations. I'll repeat myself about the qualified charitable distribution. Again, that it only applies to people who are 70 and a half, but it's a very important tool. The low limit on the state and local tax deductions hurts blue states the most, as it turns out. And the higher estate tax exemption removes a tax savings motivation for big donors. So, time will tell how much how important is that to donors, and it falls back on the charities to really tell a good story and engage their donors to make sure they don't get sold short from that. So we have recorded this webinar. It'll be available on our website in our webinar library in the next week. As you can see here, we have a number of different topics available in our webinar library, so we invite you to take advantage of those. There's lots of ways to stay in touch with us. We always appreciate hearing from you and having you follow us on Twitter, LinkedIn. Bonnie writes a regular career and life coaching blog, and we also produce a finance blog on various topics. So thank you for joining me today. As I said many times, love to hear from you. If you have questions, please send those in, and I'll make sure that you get a response. Have a great day.